Dan Collins, editor-in-chief of Futures Magazine for Traders Exclusive, coming to you live from the Flora CME Group. Earlier this week, we spoke about how the market seemed to overreact to the unemployment number last Friday. In fact, not overreact, but underreact. It was a very good number, and as you might expect, the treasuries tanked, but equities tanked too. It was somewhat of a surprise because we thought we got out of this good news is bad news and bad news is good news based on what the Fed might do. It's pretty clear that they're going to tighten in 2015, probably the middle of the year. I had already kind of expected June. You know, maybe they push it to September if the numbers slow down. But I thought it was in the market, so I was a little bit surprised that there's such a negative reaction. And I posed the question whether there's something more to it, which I think there probably is, because if you go to futuresmag.com, you can see a chart of 2001 where the Fed had cut interest rates 4.75% for a year. Well, obviously there was a lot going on in 2001. The market was tanking, and then we had 9/11 in September. But most of the rate cuts came before that, and the idea that the market can swing on the idea that sometime several months in the future the Fed could tighten by 25 basis points doesn't seem to make sense, especially since we've gone through that long period of tapering. And you know, when they announced tapering, you had that kind of crazy reaction, but markets realize that tapering's not tightening and tightening's still down the road. Well, we're getting closer to it. But they're not gonna increase rates at 50 basis points a meeting. They're not even gonna tighten at every meeting. So it didn't make sense. So the question is, if it's something else, is it an overall weakness in the markets? You need to be prepared for that. And what else could it be? Well, one thing we've seen in the last year is a huge rally in the US dollar. Now this hasn't negatively affected equities, as equities move right up along. But if you kind of look going back to the 90s, when that huge bull market, yeah, it was overextended, but what helped push it over the top? Well, the dollar had rallied all along with it up to like 120. And when they got to 110, that was when the equity market started tanking. Well, the dollar has been unbelievably strong. It rallied in 2014 from, you know, the late high 70s, low 80s to where we are right now, which is close to 100. And that seems to be a magic level there, and I think that makes equity traders nervous. And also, look, the dollar was being depressed by quantitative easing. It helps to clamp down the dollar. What do we know now? We're done with quantitative easing. The Fed will eventually have to tighten rates, which is stronger for the dollar. At the same time, the European Central Bank is initiating a QE program that'll weaken them against the dollar. This morning, Reuters reported that they think the Chinese will ease interest rates again. So you have this juxtaposition of the central banks that will continue the strengthening of the dollar. I see the weakness in the S&Ps the last week has more to do with dollar strength than the anticipation that the Fed may tighten in June 25 basis points, which I think the market kind of knew. Maybe they didn't like it, but they knew it. So as you look at this, keep an eye on the dollar. It's approaching that $100 level. The euro is approaching parity with the dollar. It's going to be hard to maintain equity bull market with the dollar being that strong. This has been Dan Collins, for editor-in-chief of Futures Magazine for Traders Exclusive. See you next time.